What's going on, you guys? My name is Zach Hartley, and in this video I want to give you 3 different strategies for how to manage your risk when it comes to trading and investing. So without any further ado, let's jump right in. Okay, so the 3 strategies we are going to cover today are the stop loss. We're going to talk about position sizing and how to actually do the correct position size based on your portfolio. And then lastly, we're going to talk about hedging. This is probably the most complicated one, but you can actually make money when stocks go down. So there's a great opportunity here that I want to share with you. Make sure you stay till the end though. We're going to start with a stop loss. Now, stop losses are pretty simple. You're probably familiar with them. They are a trade that will exit your position when the price crosses a certain level, and they're used to limit your downside. Now, everybody's probably familiar with that, but the real question and the real test of a trader or investor is, where do you place your stop loss? And I've done a bunch of research on this. I've taken a bunch of different courses and I've made my own trades. And in my experience and from what I've learned, here's the best way to think about this. You place your stop loss at the level which makes your assumption wrong based on technical support and resistance. And so when you enter a trade or an investment, you are making an assumption that the stock is going to go up for these reasons. And if the stock crosses below a certain point, your assumption is clearly just wrong. Your hypothesis, your theory, and why you think that stock was going to go up, it was clearly just wrong. And so you want your stop loss to be at the level when you hit that point. Here is an example of what this looks like. This is stock UDMY or Udemy. They're an online course platform. I really like the company. I'm watching them pretty closely right now. And as you can see, we have a very clear double bottom right here around $10. We tested it back in March. We are testing it again right now. And we are starting to test a breakout or a bounce off of this level. Now, my assumption here is that the stock has support at $10 as evidenced by the double bottom and the increased volume. The first bottom was right here in March, the second bottom just occurred, and we have increasing volume right now. And so what I am thinking in my head is that buyers are stepping in at $10 and they are acting as support at $10. And so for me, that is my assumption. And when that assumption is wrong, or in other words, when the stock crosses below $10, that's when I want to get out of my position. Now, as you can see, the ultimate low right here was $9.66. So I'm going to set my stop loss as this red line right here at $9.50. The major level of support is right around $10. It is not $10. It is around $10. We've tested as low as $9.66. So I want to have my stop loss below that, because if the price crosses below that level, my assumption is going to be wrong and I want to exit the position. So that is how you should think about a stop loss. Now, the second strategy here to manage your risk is to have good position sizing. And the reason you want to do this is because choosing the right position size can help to protect and diversify your portfolio. It can make sure that one bad stock or one bad trade isn't going to weigh you down and isn't going to destroy you or crash your account. And so in order to have the right position sizing here, the first thing you need to do is think about how much money you are willing to lose on each position. You need to have a maximum loss for each trade, and it needs to be in a dollar figure. For this example, we are going to use $500 per position. This is really dependent on your personal preference, how risky you are, and how large your portfolio is. But let's say just for me internally, I'm willing to lose $500 on a position if the trade doesn't go my way. So when we go back to our Udemy example here, we can see that the current price is $11.29.5. We're just going to round that up to $11.30 for easy math. We set our stop loss at $9.50, and so the maximum amount of money that we can lose on a per share basis is $1.80, right? If we enter at $11.30, our stop loss is at $9.50, the maximum amount of money we can lose is $1.80 per share. Now, what we said before was that we needed to determine the maximum loss per position, and for this example, like I said, it is going to be $500. And so the position size that we can take for this company, for this stock, UDMY, is going to be based on our total loss for this position divided by our loss per share, and that is going to give us 278 shares. That is the position that we can take in Udemy. That is how we calculate how many shares to buy. It is going to be based off of our maximum loss per share, which is also based off our stop loss, and our total maximum loss per position. You're just going to divide these two numbers right here, and that is going to tell you how many shares you can buy to stay within your own personal rules. This is how you make new positions in your portfolio. This is how you decide how many shares to buy. It's completely based off your risk tolerance. And if you use this strategy, it will make sure that you're not getting weighed down by any losses of more than $500. That is the entire goal of this video. It is to make sure that you don't lose money. And so if you use the first strategy of a stop loss, it will make sure that you only lose $1.80 per share. And if you use the right position sizing, it will make sure that your maximum loss is only $500 per position. If you combine both those strategies, you should be able to make sure that your downside is well protected. Now, the third strategy here can actually help you make some money depending on the scenario and depending on what happens. But basically, we're going to talk about hedging here. And hedging basically refers to betting on both sides. And so here's the scenario. You have a portfolio of different stocks that are mostly made up of NASDAQ listed stocks, and you are worried that the tech industry, which is mostly what the NASDAQ is made up of, is going to take a massive pullback. And so you're looking at your portfolio and you just say, well, crap, I'm a little bit worried here. I've got some risk here. I think we could see a pullback in the market, but I also don't want to just sell all of my shares right now and possibly realize some of those taxes. That's another thing to consider here. And so instead of selling everything and paying the taxes and getting completely out of the market, you can decide to hedge your positions. And so the way that you hedge is by betting on both sides. And there's a variety of different ways to do this. But in this scenario, you're heavily invested into the NASDAQ. So what we're going to do is we're going to buy securities that go up when the NASDAQ goes down. And so if the market sells off and we see a major correction in tech and the NASDAQ completely falls, your portfolio is going to take a hit. But what we're going to do is we're going to buy some securities that will do well in that scenario and will actually go up if the NASDAQ falls. And so yes, you will lose some money in your portfolio, but you will also make money on the positions that you buy here. And there's a variety of different ways to do that, starting with SQQQ and PSQ. SQQ and PSQ here are actually inverses of the NASDAQ. And so when the NASDAQ goes down, SQQ and PSQ actually go up in value, and so you can make some money. The interesting thing here is that with SQQ, when the NASDAQ goes down by 1%, SQQ goes up by 3%. It is a 3 times leveraged inverse of the NASDAQ, and so it will actually give you 3 times the movement in the event that you see a correction on the NASDAQ. You also have the option of buying puts. That is another great option. It's a little bit more complicated and you need to know how to trade options, but you can buy puts in QQQ or QQQM, and in that scenario you will also make money when the NASDAQ goes down. However, you will also need to set an expiry date, so there is a little bit more that goes into it, but all of these options here will increase in value when the NASDAQ decreases in value. And so if you have a portfolio made up of a bunch of different securities, you can buy put options, or you can buy leveraged inverse ETFs, or you can even buy put options against the securities that you hold. So there's lots of different options here, and you can make money even when the rest of your portfolio declines in value. Now, if you want to learn more about how to do any of this or learn more about position sizing and stop loss, definitely consider checking out my Stock Market Fundamentals course. It is completely free. It's hosted on Skillshare. You get a 1-month free trial to the entire platform when you use the link in the description to this video. There's over 12,000 students that have gone through the course. There's over 400 reviews and 1.9 million minutes of watch time. The course is only 10 hours long, so it's very easy to complete in under 1 month. And I promise you, it'll be the best free resource that you can find online. Now that's it for me today. If you got any value out of this video, please remember to click that like and subscribe button, and we'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.